Welcome back to the Deep Dive. It is Friday, January 23, 2026. And I have to say, looking at the markets this morning, I am staring at what might be the biggest contradiction in the entire crypto space right now.
It's the kind of thing that makes you squint at your monitor and just hit refresh, isn't it?
Seriously. We're looking at a piece of technology avalanche that is, it's objectively faster, cheaper, and more deeply embedded in the traditional financial system than it has ever been. We've got massive institutional pilots that have finally gone live. We have upgrades that have fundamentally rewritten the economics of how the network even functions. The machine is absolutely humming.
From a fundamental perspective, yeah, all the lights are green, the engine is primed.
But then you toggle over to the price chart, and if you bought the top back in 2021, you're still staring at a loss of, what, over 90%?
Oof.
The token is just hovering in the low double digits, pouncing between $12 and $14. It's a classic case of cognitive dissonance. The tech is winning, but the chart looks like it's losing.
That's the great fundamentals ugly chart syndrome.
Yeah.
And it drives value investors crazy because, the market can stay irrational a lot longer than you can stay solvent.
So that is our mission for this deep dive.
Yeah.
We need to bridge that gap. We're going to look past the scary candles on the chart and dissect the actual architecture changes, specifically this Avalanche 9000 upgrade people keep whispering about.
Right.
We need to figure out, is this chain a zombie just walking dead while Solana and Bitcoin run the show? Or are we sitting in the ultimate accumulation zone right before a massive re-rating?
To answer that, we've pulled a pretty heavy stack of sources. We've got the technical specs on ACP77, which is way more interesting than it sounds, I promise you.
I hope so.
Plus the 2026 outlook reports from MEXC and Bitcoin World. And of course, we did a deep dive into the analysis on what BlackRock and Securitize are actually doing behind the scenes, because that's where the real money is moving.
Let's start with the basics, though.
Yeah.
Because to understand where Avalanche is going in 2026, you have to understand what it actually is. And reading through the primer, it seems like the biggest misconception is that Avalanche is just another blockchain. People just lump it in.
That's exactly where most people get tripped up. When you picture Bitcoin or even Ethereum, you're usually picturing a single line of blocks. One lane of traffic, right?
Yeah.
Everyone is in the same queue waiting for the same bus.
Yeah.
Avalanche isn't a single chain. It's more like, well, it's actually 3 blockchains in a trench coat pretending to be one.
I love that image. 3 chains in a trench coat. Okay,
Yeah.
break that down for me. Why 3?
It all comes down to specialization. Instead of one chain trying to do everything, they split the duties. So you have 3 distinct environments, and they're all validated by what's called the primary network.
Okay.
First, there's the X chain. That's the exchange chain. It's purely for creating and trading assets. It's super specialized, very, very fast, but it's limited in what it can do. It's not for smart contracts.
Okay, so X is for moving money. Simple?
Then you have the P chain, the platform chain. Think of this as the command center, or maybe the HR department. It coordinates the validators, it keeps track of who's active, and it manages the creation of new subnets. It's the admin layer. That's the C chain, the contract chain. This is where the party happens for, I'd say, 99% of retail users. It's EVM-compatible, meaning it speaks the same language as Ethereum. So if you're using MetaMask, swapping tokens, buying an NFT, you're on the C chain.
So by splitting it up, they prevent the network from getting clogged by one specific type of activity.
Yeah.
But the magic here isn't just that they split the duties, it's how they agree on what's true.
Yeah.
The consensus. I was reading of the Snow family of protocols, and there was this analogy about gossip that finally made it click for me.
Yeah.
Because usually consensus is just complex math problems.
But yeah, mining, or proof of work, is basically a global race to solve a Sudoku puzzle. It's slow, and it's incredibly energy intensive. Even standard voting mechanisms can be slow because you need to count everyone's vote. Avalanche uses something called metastable subsampling.
Which sounds like something straight out of a Star Trek episode.
It does sound sci-fi, but let's use that colored circles analogy from the documentation. It's surprisingly intuitive. So imagine a giant stadium full of people, 50,000 people, and we need the whole stadium to agree on a color, blue or red.
Okay. I'm standing in the stadium. I see a sea of people.
In a traditional blockchain, you might wait for one person with a giant megaphone to shout, blue, and then prove they did the work to verify it. Everyone just listens to that one guy.
Right.
In Avalanche, you as an individual node, you stand up and you pick just 5 random people near you, a tiny, tiny sample, and you ask, red or blue?
Okay, so I ask my 5 neighbors, and let's say 3 of them say blue.
Since the majority of your little sample said blue, you switch your own preference to blue, then you immediately pick another 5 random people, and you do it again. But here's the key. Everyone in the stadium is doing this at the same time.
Just gossiping with their neighbors.
Precisely. And the math shows that if the room starts with even a tiny preference for blue, that preference just cascades through the crowd exponentially fast. The whole stadium tips to a single color in the blink of an eye. It happens in rounds, but it cascades like an avalanche.
And the outcome of that speed is what they call finality.
Yeah.
I feel like the crypto community in general, we mix up speed with finality a lot. We see TPS numbers, transactions per second, and just assume that's the whole story.
That is such a crucial distinction, especially now in 2026. You see chains like Solana advertising, 65,000 TPS, and that's impressive throughput, don't get me wrong. But high TPS doesn't tell you when the transaction is irreversible. Finality answers the question, when can I be 100% sure this money is mine and can't be clawed back?
On Bitcoin, that's like an hour to be truly safe.
Yeah, usually 6 blocks, so about an hour. On Ethereum, it's maybe 12 to 15 minutes. Even on some high-speed chains, there's a probability of reversal for a few seconds. On Avalanche, because of that gossip protocol, finality happens in under 1 second, usually around 700 milliseconds.
So you click, and it's just done. It's like digital cash.
It is settled. For a gamer, that's nice because you don't want lag. For a financial institution moving millions of dollars, it's a requirement. They cannot have transactions in limbo. They need to know the books are balanced instantly.
That's a good segue to the upgrades, because while the engine is fast, the chassis, it needed some work. We're in January 2026, and the big buzzword everywhere is Avalanche 9000. It sounds like a super weapon.
Right.
But it's actually referring to a network upgrade involving something called ACP77. Why is this specific proposal getting so much hype?
This is the pivot point. If we look back at, say, 2023 or 2024, the big critique of Avalanche was cost. Not transaction fees for the user, but the cost to build. If you wanted to launch your own custom blockchain, what they used to call a subnet, you had to stake 2,000 AVAX.
And at the peak price, that was over $250,000.
Even recently, it's tens of thousands of dollars. Plus, you had to run hardware to validate the primary network as well. It was a massive, massive barrier to entry. We were basically telling developers, hey, come build your app here, but first, buy this expensive plot of land and build a security fence around it.
The landlord model.
Exactly. It was so capital inefficient. ACP77 just throws that whole model out the window. It essentially decouples your custom chain from the main network validation. You no longer have to stake that 2,000 AVX.
So the upfront capital requirement is zero.
Well, the staking cost is gone, yeah.
Right.
It's been replaced by a pay-as-you-go model. You pay a continuous, much smaller fee to the P chain just to keep running. It's shifting from buying a house to, renting an apartment.
Or in tech terms, moving from buying server racks to using SaaS software as a service.
That's the perfect analogy. And it just changes the math completely for a startup. If I have a cool idea for a blockchain game, I don't need to go raise a seed round just to turn the servers on.
It creates a permissionless environment.
It does. We looked at a report from Zeev, an infrastructure provider. They estimated that under the old model, running a validator node cost about $250 a month in hardware, plus that huge capital lockup. With ACP77, the hardware requirements dropped so much that monthly costs are down to about $80.
So the barrier to entry just dropped by, 99%?
99.9%, arguably. And this is why they've rebranded them from subnets to Avalanche L1s. The vision is no longer just a few dozen high-end partners. The goal is the internet of blockchains. Thousands of app-specific chains running in parallel, all talking to each other, but cheap enough that an indie game studio can afford one.
This feels like the moment where the tech actually catches up to the marketing pitch. But let's connect this to the actual users. Because if I look at crypto Twitter right now, the retail crowd is still chasing meme coins on Solana. It's fast, it's one chain, it's simple. Avalanche seems to be courting a completely different demographic.
They're pivoting hard. You can see it in every partnership they announce. The narrative has shifted from being a retail Ethereum killer to being the premier rail for institutional finance and real-world assets, RWAs.
The suits.
But the suits are bringing the liquidity. Look at Securitize. Late last year, 2025, they got licensed to operate a DLT trading system in the European Union. They're bridging US and EU markets, and they chose Avalanche as the underlying layer.
Because of that sub-second finality we were just talking about.
That and specific compliance features. And then you have BlackRock. The BlackRock BUIDL fund has managed over $500 million in tokenized assets on the network. That's not a pilot where they test with 50 grand in a sandbox. That's $500 million of real value sitting on-chain.
We also saw notes on Citi and JP Morgan using these evergreen subnets. Why specifically Avalanche, though? I mean, Ethereum's the biggest, Solana's the fastest. Why pick the one in the middle?
It comes down to one phrase: performance isolation. This is the killer feature for banks. Imagine Solana is a massive highway. It's wide, it's fast, but if a new meme coin launches or a huge NFT drop happens, everyone is on that same highway.
The noisy neighbor problem, traffic jams.
Exactly. Even if the highway is wide, congestion happens. A bank like Citi cannot afford for their foreign exchange settlements to fail or slow down just because a cartoon dog coin is pumping. It's a liability risk they just cannot take.
Right. Sorry, we couldn't clear your billion-dollar trade, sir. The dog coin is mooning. That phone call does not go well.
It really doesn't. On Avalanche, because of this L1 structure, the bank gets its own dedicated lane. It's a private road. What happens on a gaming L1 or a DeFi L1 has physically zero impact on the bank's L1. That isolation is non-negotiable for compliance and reliability. It scales horizontally, not vertically.
So institutions want private lanes. But is there anything here for the rest of us? The gamers. Yeah, the people who actually want to use crypto for something other than just banking.
Definitely. Gaming is the other massive vertical that benefits from this L1 structure. I mean, we've finally seen the release of Shrapnel, that AAA shooter everyone was waiting for, and Off the Grid. These aren't simple pixel games. These are high-fidelity, console-quality games.
And how does ACP77 help them? Is it just the cost?
The cost, yes, but also customization. A game developer can spin up an Avalanche L1 and decide, I don't want my players to even know they're using crypto. They can set the gas token to be their own in-game currency, or they can subsidize the gas entirely so transactions are free for the player.
That's huge for adoption. I shouldn't have to explain to my friend that he needs to go to Coinbase, buy AVAX, transfer it to a wallet, and pay gas just to pick up a sword.
Exactly. It removes the friction. And speaking of removing friction, we have to mention the Granite upgrade that happened back in November 2025.
Oh, right, the biometric thing. I remember the headline, but I didn't dive into it.
This was a subtle but massive game changer for user experience. It added support for this 29256R1 curve. I know it's technical jargon,
right,
but what it means is that the blockchain now natively supports the cryptography used in the secure enclave of your iPhone and your Android phone.
So logging into a crypto game or signing a transaction just feels like logging into your banking app.
That's right.
With your face.
Exactly. No more copying and pasting a 12-word seed phrase onto a piece of paper. You scan your face, and the transaction is signed via the hardware in your phone. It makes the crypto part invisible. That's how you get the next 100 million users.
Okay, so let's pause and look at the scoreboard here. We have sub-second finality. We have a 99% cost reduction for launching chains via ACP77. We have BlackRock and Citi on board. We have AAA gaming with invisible logins.
Yeah.
So here's the uncomfortable question, the elephant in the room.
The price tag.
Why is the token trading at $12? We're down 90% from the highs. If the tech is so good, why is the chart so bad?
It's the multi-billion-dollar question, and the analysts in our source material are pretty split on this. It really, really depends on your time frame.
Give me the bear case first. Why does this all fail?
The bearish case, which puts the token dropping to around $850 later this year, is basically the zombie chain scenario. The argument is that while the tech is great, the liquidity and the mindshare are gone, retail users are sticky. They're on Solana, they're on Base. They aren't coming back to Avalanche because the multi-chain experience is just too complex.
It's harder to navigate. Wait, is my money on the C chain or the X chain or the Shrapnel L1 versus just, it's in my wallet?
Exactly. It creates fragmentation. And if the AVX Hub v2 portal doesn't fix that UX problem, the chain just becomes a ghost town of empty high-tech infrastructure, a playground for banks that nobody else visits.
Okay, that's the gloom and doom. What's the base case? What happens if things just go, okay.
The base case sees a recovery to the $24 to $65 range in 2026. This assumes that Avalanche 9000 succeeds, and we start seeing those thousands of L1s actually launching. It assumes the institutional pilots turn into permanent infrastructure and start generating real fees.
And the bull case. Are we seeing new all-time highs this year?
Surprisingly, no. Even the most bullish reports we looked at for 2026 cap out around $85, which, look, that would be a massive 6x or 7x from here, which is incredible, but it's still not breaking the 146 record from 2021.
Why not? Why are they so conservative?
Because institutional adoption is slow. It moves at the speed of regulation, not the speed of crypto Twitter. The analysts all seem to think the $100 barrier is more of a 2027 or 2028 story. It's a long game. Real-world assets just take time to migrate on-chain.
But there is a mechanics angle here that might accelerate things, right? The burn mechanism. I was surprised to see how aggressive it is compared to other chains.
It's one of the most aggressive supply sinks in crypto, period. Avalanche burns 100% of its transaction fees.
Compare that to Ethereum for me.
On Ethereum, a portion of the fee is burned, but a portion goes to the validators as a tip. On Avalanche, the network fees are just deleted. Poof, gone forever.
Wow.
So as usage grows, as those thousands of L1s start paying their pay-as-you-go rent to the P-chain, the supply of AVX effectively shrinks.
It becomes deflationary.
Theoretically, yes. If that Internet of Blockchains vision worked, you have thousands of tenants paying rent and AVX, and all of that rent is being burned. It creates a scarcity squeeze. But again, that requires the tenants to actually move in.
So it really comes down to this waiting game. We're kind of stuck between the retail hype cycle, which Avalanche is clearly losing right now to Solana, and the institutional utility cycle, which hasn't fully arrived yet.
That is the perfect way to frame it. The market loves shiny new toys. Right now, infrastructure is boring. But in technology investing, boring is often where the real value settles after all the hype dies down.
It reminds me of the dot-com bubble. The companies that built the plumbing, the fiber optics, the servers, they didn't moon overnight, but they're the ones still standing 20 years later.
While the pets.com of the world are long gone, the question is whether Avalanche is the Cisco of this era or just a really advanced Betamax player.
So here's the thought I want to leave you with today. In a world where meme coins and quick flips grab every single headline, is betting on boring institutional infrastructure actually the contrarian alpha play for the next decade? Or will the sheer complexity of managing thousands of custom chains prevent Avalanche from ever recapturing that retail magic?
It's a risk-reward ratio that everyone has to calculate for themselves. But one thing is for sure. The technology is no longer the bottleneck.
If you want to dive deeper into the specs yourself, check out the new AVAX Hub V2 ecosystem portal. The sources say it's the best place to actually see what's being built rather than just staring at price tickers.
Stay curious.
Thanks for riding along on this deep dive. We'll catch you on the next one.